This is the Asia Trade. I'm Paul Allen in Sydney, where the market has just opened. The top stories this hour. Asian stocks set to open under pressure as the Fed delivers a hawkish 25 basis point rate cut and forecasting fewer reductions next year. The S&P 500 suffers its worst decision day loss in almost a quarter century. The Bank of Japan makes its rate call today. Officials are seen holding ahead of a possible January hike. Plus, New Zealand sliding into a deeper than expected recession as elevated interest rates curb demand. All right, we have just opened for trade here in Australia. Today's show probably going to be brought to you by the colour red. We're already off about 1/3 of 1%, but you can expect to see those losses deepen, I suspect, as the staggered open continues to play out here in Australia. Nikkei futures, meanwhile, traded out of Chicago. Well, they're actually in modestly positive territory at the moment. It is, of course, Bank of Japan decision day as well. But look at the yen, 154.74. The offshore yuan also weakening to its lowest since 2023. The US dollar rampant, the strongest in more than 2 years on that Fed decision. It was, as we expected, a hawkish 25 basis point cut. But the outlook for 2025 and some of the rhetoric really spooking markets there. S&P futures, however, looking kind of flat at the moment after the market did fall about 3%. That was the biggest post-Fed drop since 2001. Every sector on that index was weaker. The NASDAQ futures, meanwhile, they're poised to open a little bit softer as well. Crude prices, though, holding up. Oil did trim its gains post that Fed decision. US dollar, of course, surged. US crude exports are looking pretty strong, but there is, of course, ongoing concern about weak China demand. All right, what kicked off all of this? Let's take a listen to the man of the hour. It is the Fed Governor, Jay Powell.
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut.
All right, Fed Chair Jerome Powell there. Let's get to Patricia now, Director of the MPA Program in Economic Management at Columbia University. Patricia, the decision itself was unsurprising, but some of that guidance obviously wrong-footing the market. There's some concern over progress on inflation in particular. So let's start there. What's your outlook for inflation in the next year? And could the 2 cuts being forecast by the dots possibly become 1 or even none?
Actually, they could have been more hawkish than they were, particularly about next year, given how much their forecast was revised up. And I think their forecast is, as good as anybody else's, certainly as good as mine. They raised their inflation forecast a lot. Inflation is stubborn. This is actually a historical story, not a surprise. It's hard to get inflation down that last little bit, and this is basically what they're facing now. But they also didn't cut growth for next year. So the fact they're cutting it all next year is actually mildly surprising to me. But I do think that the most interesting part of the statement and the numbers were that the amount of uncertainty they have about what they're going to be doing next year. Very high, as high as I've seen COVID. And I think that means there's potentials for lots of changes in direction in Fed policy going forward.
I want to talk about the guidance for next year in a moment, but just looking at today's decision, there was one dissent. Did this cut even need to happen?
Honestly, I didn't think it did. I was pretty sure it was going to. That's what they had forecasted. It's not a terrible mistake to do 25 more. The real interest rate, is still pretty high. But then again, the economy is still at full employment. Chair Powell did talk about the softening in the labor market, but frankly, it hasn't softened that much. And so, truthfully, they could have postponed thinking about making another cut until next year, in my opinion.
In some ways, do you feel like we might be losing sight of the big picture here? I mean, you mentioned the jobs market there. Jay Powell mentioned that as well, saying it's not cooling at a pace that raises concerns. We've got a US consumer that appears to be in good health. Growth is robust as well. Plenty of silver linings to this cloud, aren't there?
Oh, there's absolutely silver linings all over the place. Real wage growth is quite strong, reflecting the labor market, and productivity growth, which is allowing those wage gains without actually accelerating inflation, is very important, and it's allowing American households to catch up. The chair pointed this out in the press conference as well, to sort of catch up for the years when inflation went up so rapidly. But it takes time for those things to happen, and so what you want to do, if you can, is to create a set of economic conditions that continues that sort of virtuous circle: a relatively strong labor market, relatively good growth and productivity growth, and that way you can do the gradualism that you want to do and that the Fed wants to do in getting things back to normal.
Yeah, well, Chair Powell also acknowledged a lot of unknowns coming in the year ahead and was really reluctant to engage in planning around hypotheticals. But I'll ask you to do it for us. What are the risks of some of the unintended consequences from tariffs, a trade war, and now potentially an increase to the debt ceiling as well?
Yes. So the policy risks of the incoming administrations are significant. The inflation risk associated with them in particular are potentially significant, but it really depends on how they're implemented. So let me kind of go through a couple of them, if you'll give me a minute. Start with tariffs. If this administration really does across-the-board tariffs, and if there's retaliation, which there probably would be, that is significantly inflationary. It may slow down growth too, but it is inflationary in the near term. The question, of course, is whether the administration will actually do this. In the previous Trump administration, the president talked a lot more about imposing tariffs and threatened many more tariffs than were actually implemented. So that one's an open question. It seems to me it really, really depends on the size and the scale of the tariffs as to how inflationary it's going to be. On the fiscal policy side, it's interesting. Their strategy is quite clear. They want to cut taxes and cut spending. That's standard for the Republicans. But here's the problem. Tax cuts are pretty easy to do. They're quick to do as well. Spending cuts are hard. And I don't think that this administration is really going to take on entitlements, and they're probably not going to cut defense very much. And that leaves spending cuts that are going to be probably smaller and potentially slower, which means you may get stimulus from the tax cuts before you get the impact of lower spending. If that's the case, then a 6% deficit to GDP ratio in the U.S. could go up in the very short run. That is absolutely stimulative, and given that the economy is at full employment and inflation is above target, it's probably inflationary too. So that's an open question. Again, it really depends on what they do. But if the tax cuts come large and first, there's a potential that could be inflationary. The last bit of the policy that is a question, of course, less of a question probably, is about immigration. Shutting the borders is definitely going to reduce the supply of unskilled labor right away. That's what happened in the first Trump administration. And eventually, that can be quite inflationary. When this happened in 2016, 2017, during the first administration, remember, the labor market was weak, the U.S. economy was underperforming, and inflation was below target. But cutting down labor supply significantly over several years has the potential to reverse that. We saw a little bit of that. Part of what happened post-COVID was because of previous immigration policy. So that's potentially quite inflationary as well. It will probably be slower to appear, but there's absolutely no question that it's a risk. Last and not least is an open question. Yes, please.
Well, you're sketching out a fairly compelling argument for inflation in 2025, but at the same time, we've got an incoming President Trump who's unlikely to be happy with a Fed that's looking at higher for longer. Now, of course, Chair Powell saying he's not going anywhere until his term expires, but in what ways could President-elect Trump make life difficult for the Fed, not just with inflationary policy, but with some fairly hawkish anti-Fed rhetoric, which we might be expecting to see anytime very soon?
Yes. I think he could make the Fed very uncomfortable. It is interesting that he has already said publicly that he does not plan to attempt to get Chair Powell to resign before the end of his term in 2026, but time will tell. If the Fed actually ends up raising rates rather than cutting rates in 2026, I am guessing that the rhetoric will be very intense. I'm in no way a lawyer, so I won't give you a formal opinion about how possible it is for the president to actually get Chair Powell to resign. My understanding is it would be quite difficult, but he could make life very, very unpleasant for the Fed for quite some time.
All right, Patricia Mossa, Director of the MPA Program in Economic Management at Columbia University. Thanks so much for joining us. Coming up on the Age of Trade, we're going to talk market strategy with JPMorgan and Nuveen as the Fed delivers that hawkish cut. Plus, BlackRock joins us to look ahead to the Bank of Japan decision. Much more ahead. This is Bloomberg. New Zealand's third quarter GDP contracted much more than expected, putting the economy into recession. Bloomberg News reporter Tracy Withers joins us now from Wellington. Tracy, we were expecting a contraction, but perhaps not quite this big. What happened?
Well, you're correct, Paul. Of course, the 1% contraction compared to 0.2% expected by economists. High interest rates have hit hard. Business confidence through the third quarter, we're talking, was down. Manufacturing was contracting. Construction was weak. There weren't many bright spots at all. Exports also fell. So all in all, it was a much bigger outturn than people expected.
So what's the next move here from the RBNZ? One would probably anticipate more easing, but did they get it wrong? Did they leave it too late?
Well, we've asked that question, of course, over the last few months since the easing began in August. They've certainly stepped up the size of rate cuts with 50 basis point moves in October and November, and the governor signalled that the next decision in February will probably also be 50 basis points. Of course, economists are now pricing in, or rather investors are now pricing in, the official cash rate falling as low as 3% by the end of next year from 4.25 currently, whereas the Reserve Bank only expects 3.5% by the end of next year. So there's a bit of a difference in the market expectations emerging.
All right, Tracy Withers there in Wellington after that much worse than expected GDP reading in New Zealand, now in a triple dip recession. Well, let's get back to the Fed and that rate cut. Officials signalling greater caution over how quickly they can keep on easing next year. Garfield Reynolds leads our Markets Live Asia coverage, joins us now. So Garfield, we've got new dots, 2 cuts next year, 1 dissent though. Could we maybe see less than 2? Has this story played out yet?
No, the story definitely hasn't played out, and this was a significantly hawkish pivot. And part of the concern has to be that when you read what the Fed said about conditions now, and you look at their projections and all the rest of it, you would really argue that they shouldn't have cut on the economic front at all today. So that kind of means they've front-loaded things, which increases the potential that if the economy keeps tracking the way that it's tracking, that yeah, they won't need to go 2. They might only need to go 1. They might decide they don't need to go at all. Given that backdrop, a lot is going to depend on how the economy develops and whether or not President-elect Trump's policies have an inflationary impact when he becomes President Trump. Now, the Fed actually tried to take some of that into account, as it turned out, which was another one of the surprises. I'd been expecting, and some others have been expecting, that they would eschew looking at that and more just concern themselves with the one clear outcome, which is that the original Trump corporate tax cuts will be extended. That's got the potential to drive yields up and to boost growth. and therefore be inflationary that way. So that you can be certain of. The tariffs, not so much. But if the tariffs meet or exceed inflationary concerns, then that would trigger more delays to rate cuts. So there's some potential that the Fed's going to be where it is now for quite some time to come.
Well, let's take a look at some of that market reaction that we saw. We had the S&P suffering its worst post-Fed drop since, I think, 2001. Does this look reasonable, rational?
Well, to some extent, it looks rational from the point of view that equities had been looking irrationally exuberant for some time. Yes, the AI boom is an important driver for increased profits, a justification to some extent for some of the very expensive valuations relative to expected earnings that we had seen. But all the same, there had been growing concern, the lack of breadth in the market, the way it kept on grinding higher in the face of growing uncertainties. So to some extent, that sell-off is the market getting back closer to the reality. And after all, you might think that in fact it will bounce back in not too long an order, precisely because the Fed's expectations are built around a strong economy. So if the economy is strong, that should be good for stocks. And bond yields are still not hugely high relative to the way the economy is traveling. So given all of that, perhaps it's an overreaction, but I'd rather look at it as being an appropriate reaction as to when you look at where it's got equities at now, that took out some of the froth that was in there on expectations that both the Fed and President-elect Trump, when he becomes president, are going to act to keep equities rising ad infinitum.
Mm-hmm. Well, look, we've got the Bank of Japan next, which by comparison should be reassuringly dull, or will it be? Governor Ueda does have the capacity to surprise.
He definitely has the capacity to surprise, and in fact, the BOJ has a lot of form when it comes to December surprises. Usually it meets a little bit later, closer to Christmas, to exacerbate the surprise potential by the lack of liquidity in the system. There is an outside chance you would think that if you look at what the Fed has done to US rates and to the US dollar, you would argue that the BOJ actually has room to surprise with a hike today. That would be a huge shock because Ueda, he's more likely to surprise with some of his rhetoric and saying things that are at odds with the statement or go further than the statement than to actually surprise by a sudden action. So the more likely surprise would be either if he taxed dovish, which would really hurt the yen, or if he gives a really solid outline for BOJ hikes in the coming year, that could bring the yen back, the dollar-yen rate back down, and might be a nasty surprise for Japanese stocks that are already selling off today.
All right, Garfield Reynolds there, who leads Markets Live Asia coverage. And you can follow more on this story and all of the day's trading on our Markets Live blog. You can find that on the Bloomberg. MLIV Go is your command. You can get a market rundown in one click, and there's commentary and analysis from Bloomberg's expert editors, so you can find out what's affecting your investments right now. We have more ahead on the Asia trade. This is Bloomberg. President-elect Donald Trump says he opposes a proposed government funding bill threatening a stopgap measure that would keep the government open until mid-March. Our politics editor Laura Davison joins us now. So, Laura, are we going to see a government shutdown here? And time's running out to get this sorted out. What's the next move?
Yeah, so the next move is House Republicans, led by House Speaker Mike Johnson, needs to figure out what they're going to do. Trump has come out and said that he opposes the version of the bill that they had put forward yesterday. Sort of the potential options here is that Johnson pulls that bill and introduces a new, more slimmed down version. What Trump said he didn't like is that there were some other spending priorities that Democrats in particular wanted in this bill. The other more complicated issue is Trump also wants to vote to raise the debt ceiling in this bill. This is not a vote that Congress is planning to take until mid next year, summer sometime. But Trump wants to do it under Biden's watch versus under his. This is a politically fraught vote. Many Republicans don't like taking this vote. Getting that done in the next 48 hours is going to be very complicated. So it is unclear exactly how to proceed. And the chances of a shutdown went up significantly just a couple hours ago when Trump came out with his opposition on this bill.
Yeah, well, of course, as you say, Mike Johnson, the Speaker, helped broker this, but we're also hearing from Elon Musk, who's criticising this bill, and his criticism comes laced with threats against any Republican lawmaker that presumes to support it. Is Mike Johnson's job safe here? Could we see a new Speaker next year?
We absolutely could. This bill, at the start of the week was not seen as being something that was super controversial. Republicans and all members of Congress wanted to vote on this and then go home for the Christmas holiday. That's looking more and more questionable here. Musk then came out and said, look, I'm going to fund primary challenges to lawmakers who support this bill. Johnson has a very difficult job keeping his conference together. He has, some members who are not going to be happy with his changes. He also has to keep President-elect Trump happy as well. And these are the kinds of issues over spending, over negotiating with Democrats, over the amount of spending that have caused problems for previous House speakers. Kevin McCarthy, who had the job before Johnson, was ousted over this. Same with going into the past. Boehner, for example, was also ousted over questions about government spending from the right flank in the Republican Party. So Johnson faces a vote at the start of next year. So this is all very much into question about whether he will continue and whether, if so, whether he will be elected.
You talk about Trump's desire for a slimmed-down bill. We're not just speaking figuratively here, are we? It's about 1,500 pages long, I believe. What are the hopes of renegotiating this from square one with 2 days left?
Yeah, so the vast majority of this bill is basically just a straight extension of current government funding for another 3 months. It just takes what's currently being spent, what's currently being negotiated, and just moves the can down the road a little bit. The things that are sort of in play here are some provisions for disaster aid, so an extension of the farm bill, as well as additional money for child care funding. So these are the things that were sort of tacked onto it, and those are the potential pieces that could be negotiated over the next 48 hours. Doing a whole-scale renegotiation of all of the government funding, that's simply out of the question at this point, given the timing.
All right, politics editor Laura Davison there. Let's take a look at how our foreign exchange is tracking. Pretty much everything just being dwarfed by the US dollar at the moment. It's the strongest in more than 2 years. We saw the dollar spot index rising 0.9% following those Fed remarks and the new set of dot plots. Dollar spot index up 7% on year. Take a look at the offshore yuan. That's the lowest since 2023. And we've got a yen at 154.62 ahead of the Bank of Japan meeting. We have more to come on the Asia trade. This is Bloomberg.
The committee decided to lower the target range for the federal funds rate by a 0.25 percentage point. Committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. To cut further after this point, I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market.
That is Federal Reserve Chair Jerome Powell speaking there. Let's take a look at how some of these Japanese assets are tracking following that decision to cut rates, a hawkish cut by 25 basis points. We've got a much, much weaker yen, 154.64, although to be fair, pretty much everything weaker against the greenback after that decision. Nikkei futures traded out of Singapore now. That's a bit more like it. They're off about 1.6, 1.7%. We are anticipating a reasonably large amount of selling across the Asia-Pacific today after we saw the S&P suffer its worst post-Fed decline since way back in 2001. Now, another big mover today was Micron. We did see most US chip stocks slumping in after-hours trade. And this is after Micron missed revenue forecast projections by about $1 billion. This was due to sluggish demand for smartphones and personal computers. Bloomberg Intelligence tech analyst Jake Silverman joins us now. So, Jake, tell us what the key takeaways from these results were, and how's the outlook for Micron?
Yeah, so I think the biggest takeaway is just that there's excess inventory at PC and smartphone customers, though sell-through of PCs and smartphones remains relatively okay. On the bright side, data center demand remains pretty strong, although data center SSDs seem to be taking a little bit of a pause.
To what degree is there kind of two stories going on here? We've got the legacy chip business, which is still perhaps dealing with a glut, and then the AI business. Which of these two forces are the stronger?
Yeah, so I think near term, it seems like the traditional business where you'd see PCs, smartphones, that's definitely dragging on results right now. And data center, like I mentioned before, which is mostly AI at this point, although traditional compute is doing a little bit better than expected. So that's having, it's pretty strong, but the overall impact from traditional memory excess inventories is more than offsetting the strength that we're seeing from AI right now.
How's consumer demand for both these businesses?
Yeah, it seems like consumer demand is actually holding up relatively okay. So earlier this year, there was a little bit of excess inventory build at PC and smartphone customers, and part of this was because prices were anticipated to increase, which they did. And so to get ahead of this, OEMs were building inventory, and it seems like Micron may have not quite anticipated the level of inventory build that was occurring, but sell into these customers is now weaker than sell through. So it sounds like consumer demand, for the most part, is still holding up okay.
All right, Bloomberg Intelligence tech analyst Jake Silverman there. Nissan's US-listed shares jumped the most in 25 years. This, of course, on the news of its merger talks with Honda. A Bloomberg source says those discussions accelerated after Foxconn approached Nissan about acquiring a stake in the company. So for more on this, let's get to transport reporter Nicholas Takahashi. So, Nicholas, what does Foxconn's presence in all of this mean for the deal?
Well, it definitely complicates things. Maybe it sheds a light more so on how this deal came about, or how Honda and Nissan started talking about a capital tie-up, or even the establishment of a holding company. But moving forward, it definitely throws sort of a rock into the water as to how Honda and Nissan are going to move forward, what kind of pressures they're feeling, and what form that merger will take. Foxconn, as some people will remember, took a 2/3 stake in Sony in 2016. And for almost half a decade now, they've been pushing to get into the EV business. So while this isn't completely out of left field, it sort of makes the situation more interesting.
So what can Honda gain from this tie-up with Nissan? Because while Nissan shares have risen, we've seen Honda lose some ground.
Yeah, I think the share movement is indicative of that question. What Nissan has to gain from a partnership with Honda is a bit more self-evident. Cratering profits born out of poor sales in the US and China forced the company to lay off thousands of workers and reduce production capacity. But for Honda, things have been going pretty well. I think the main thing is their focus on building scale in North America, where hybrids are selling very well, and stemming the bleeding in China, where EVs have taken hold.
So what does this mean for Japan, Japan's auto industry and the global industry more broadly?
Well, depending on how the deal shakes out, this could be a threshold moment for the country. Effectively, if Honda and Nissan and even Mitsubishi form an alliance, that would pit itself against Toyota's alliance with Mazda, Subaru, and Suzuki, effectively parting the country's automotive industry. And that wouldn't just have implications for the domestic market. That would vibrate across the global industry, not least of all in China and North America and across Europe as well. So whatever happens over the next couple of days, I think, are going to have ramifications throughout the rest of the industry.
All right, transport reporter Nicholas Takahashi there. We have more ahead on the Asia trade. This is Bloomberg.
What's the rush to keep cutting rates? Let's just back up a little bit. I think also they do have to listen to what's being talked about at Mar-a-Lago.
With this hawkish tone, this is sort of the perfect way for him to say, we're doing our job, we're looking at the data, it's coming in stronger, the economy's solid, and it justifies higher rates.
This is not going to be a great forecast for where the Fed's future forecasts have been, because they've been just so whipped around by short-term movements in data.
I think today's message was they have less conviction about that downward path of inflation.
Even with a 25 basis point cut, they maintain that level of restriction, and that they're still kind of being able to balance the risks assessment.
Bloomberg TV guests there reacting to the Fed's decision to cut rates. That was very much expected, but perhaps some of the commentary wasn't. The dots reflecting maybe just 2 more cuts in 2025. Some of the commentary we're getting suggests maybe nothing at all. We've got US futures poised to in slightly positive territory, but that perhaps reflects what we might see a rebound after some of the very aggressive selling that we saw today. The biggest sell-off that we've seen since August and the biggest post-Fed sell-off since 2001. But futures indicating something of a, modest recovery for the day ahead. Let's check in on how we're doing in Australia. No surprises here. We're off about 2% right now, and we would, looking at sector by sector, every sector in the red at the moment. Information technologies and materials, the 2 worst performing at the moment. We've got a 10-year yield ticking up slightly, but the Aussie dollar, one of the many casualties today, trading now just 62 cents, only just above it as well. The US dollar rampant. I think it's its highest in about 2 years. The Bloomberg Dollar Spot Index gaining 0.9% following that Fed statement. Well, ANZ Group has withdrawn more of outgoing CEO Shane Elliott's compensation after acknowledging a resolution was likely to get voted down by shareholders at its annual general meeting. Our finance correspondent for Australia and New Zealand, Harry Brumpton, joins us now for the latest. Harry, this resolution pulled at the last minute. Is there a whiff of panic in the air?
High drama, mate. Yeah, a few just minutes before the AGM was due to start at 9 a.m, ANZ, released a statement that the resolution number 4, which was relating to Shane Elliott's long-term bonus package, was being withdrawn. Their estimates of the shareholder votes were that the vote was going to be really very much 50-50. So, in light of that and the shareholder pushback, they decided to pull that. They also did record a strike against them. So in Australia, under what's called the 2 strikes rule, if more than 25% of shareholders vote against the board's remuneration package for 2 years running, then there can be what's called a spill, and basically the entire board can be purged and has to get re-elected. And that's not actually uncommon. That happened to Westpac Bank back in 2019, you might remember. So, they are, skating on thin ice. And this is, Shane Elliott already had his incentive bonus reduced by about $1 million earlier this year in light of some of the scandals that's been going on that the bank's been reacting to, which we can discuss. But But yeah, I think there was definitely a feeling among shareholders that perhaps there hasn't been quite enough action taken, quite enough remediation done. They're still under multiple investigations from both regulators and under internal reviews and things regarding what's been going on, especially from the trading division. So it's the first kind of tangible evidence, or first tangible consequences as well, and the first time they've had to front shareholders about all this stuff.
Shane Elliott's been there for a long time, and he's the only one to survive the Banking Royal Commission as well, but perhaps not the farewell he was expecting. And what sort of challenge does this speak to the new incoming CEO?
Yeah, totally. I mean, it does. It sets up the bank for a bit of a turnaround. Not only, I mean, it's ANZ's been bubbling along and doing quite well in some ways, but it has been the worst performing among the big four banks this year, and on a share price performance basis, as well as just being an ever-giving story and an ever-giving font of bad news, and definitely not the year that Shane Elliott was hoping for. I mean, he's into his 9th year as CEO, that he has been wanting to step down. I mean, he did the big acquisition of Suncorp Bank to expand the bank's retail footprint in the fast-growing state of Queensland, and really start being more aggressive on mortgage growth, as well as expanding quite swiftly offshore in some of the Asian markets. So he'd probably been hoping to really kind of cruise, bed down that acquisition, celebrate 50 years of business in Singapore. It was not the year he's been hoping for, I think.
All right, finance correspondent for Australia and New Zealand, Harry Brumpton there. We have more ahead on the Asia trade. This is Bloomberg. The US Supreme Court says it's going to hear TikTok's challenge to a potential US ban early next month, about 9 days before it's due to take effect. Let's bring in our China correspondent Minmin Lo in Hong Kong. So Minmin, what are the chances of TikTok winning this case?
Well, a Bloomberg intelligence analyst is giving TikTok a 30% chance of winning, and that is despite the Supreme Court really pushing through this case at an unprecedented pace. As you said, they're allotting 2 hours of time on January 10, which is double the usual amount of time, but it's just a little more than a week before January 19, when the rule, the divest or sell rule, will kick in. And obviously, the court has chosen not to grant TikTok's request to impose an injunction to freeze that January 19 deadline, which would have given the courts more time to decide. And Bloomberg Intelligence thinks that's because perhaps only 4 of the justices are supportive of TikTok's case at this point. And in the absence of that pause on the deadline, we can expect the Supreme Court to rule very quickly. And at the heart of this case, of course, is TikTok arguing that this rule is in violation of the First Amendment rights to free speech. But earlier in the month, we know that 3 judges in the DC circuit had unanimously upheld the rule, saying that Congress and the executive are entitled to a wide berth to decide or determine national security concerns. And so it's going to be an uphill battle for TikTok, according to analysts, in a courtroom that is quite conservative leaning to overturn this rule.
So what's at stake here if the divest or sell rule is upheld?
Well, obviously, TikTok's fate as well as its competitors are at stake here, because TikTok has said that it will not be able to make any progress in selling the app by January 19th. And it's also said that even a 1-month suspension is going to cost it about 1/3 of its users and 29% of its targeted global ad sales for the year. But meantime, you have its competitors like Alphabet, Meta, Snap. They are going to gain at the expense of TikTok. Some of the companies that support TikTok, like Oracle, which provides the servers, they're going to get a revenue hit as well. And another big question mark is what Trump would do, because January 19 is just a day before the inauguration of the president-elect. And we know Trump has said before that he has a soft spot in his heart for TikTok, given that TikTok has helped to sway a lot of young voters during his election campaign. But there are not a lot of options that Trump has, because while he has the power to approve any divestment deal, even even if he approves it, Beijing may block it if it involves selling TikTok's algorithm. Trump could also announce that his Justice Department will not enforce the rule, but that is very unusual, and the Supreme Court could still appoint someone to do it. And the last option that Trump has is to persuade Congress to pass a new rule to overrule the previous one, but that is a very long shot, just given the bipartisan support there is for this rule.
All right, Bloomberg's China correspondent Min Lo there. Salesforce CEO Marc Benioff says AI is driving a wave of new customer demand and greater efficiency for the cloud-based software company. Benioff spoke with Bloomberg about the impact of their new Agentforce technology.
Well, this is the most exciting thing I've ever worked on, really, in my entire career, which is the idea that humans with agents are driving customer success together. And we started talking about this at our Dreamforce conference a couple of months ago. Now our Salesforce, our COO, Brian, just told me in the event that we've signed more than 1,000 contracts with customers to deploy. But probably the most exciting deployment, Anne-Marie, is that Salesforce has this up and running for our customers. Help.salesforce.com is live on Agentforce as of today. And so we have thousands of agents working with thousands of customers, working in hand with thousands of our human support agents, resolving customer success. And we've dramatically reduced the number of cases that we have to escalate to humans. It's an incredible moment.
So you have also a number of customers in vastly different industries using this technology, Adecco versus Saks. How are they each adapting it to their business use case?
Well, you're right. I think companies in every single industry have started to deploy this technology because, look, the human workforce is quite stagnant and everybody wants growth. So by providing digital labor, we're able to grow these companies in entirely new ways. This is a big thought, and you're right. Saks or a company like Adecco or Disney or Wiley or RBC Bank, all of these companies have the ability now to augment their employees, their human employees, with digital workers. And this is an incredible moment where we can begin to see a partnership between human labor and digital labor. It's going to deliver a much lower cost, much easier to use, and also much higher levels of accuracy and very low hallucinogens in the AI layer.
A lot of this is being pitched as being able to save labor costs, needing less employees. Are you finding ways to do that within Salesforce itself?
Yes, absolutely. I mean, now that we have, I'll give you an example. We do about 35,000 customer support inquiries every single week on help.salesforce.com. And before the agentic layer was in place, or before Agentforce was in place, well, I would say about 60% of those were able to be resolved by the computer, its software, and 40% then was handled by our thousands of support agents. Well, our accuracy has gone up to over 83% of all of our inquiries are now resolved automatically by Agentforce. And only 5,000 inquiries a week are being handled by humans. So that is a big advancements in technology in its ability to deliver an accurate response at the AI layer that's able to let me do new things and rebalance that entire workforce.
Incredibly more efficient, but does this mean there's going to be less employees? For a lot of companies, including Salesforce, does this mean layoffs?
For me, what this means is growth. I can rebalance my support expense into my revenue expense. And many of these same employees who are currently working in support can be business development representatives, sales development representatives, account executives, even solution engineers. It's an incredible opportunity for me to close more deals and to be more customer facing. Of course, I have an obligation to resolve every customer support issue. And up to this point, that meant I needed thousands and thousands of customer support engineers. Today, I need less.
When will the AI dollars start to flow in? So not just from Data Cloud, but actually from AI Agent?
Well, today, Salesforce is already the largest enterprise AI provider in the world. We'll do 2 trillion transactions on what we call our Einstein platform this week alone. And of course, that's been an incremental growth over the last 10 years of Einstein being available. Now, when we talk about Agentforce, it's another extension of that where we're able to actually resolve these customer interactions using this agent platform. That's a big shift forward.
Salesforce CEO Marc Benioff there, speaking with our colleague Anne-Marie Hordern. All right, it's going to be a wild ride today. Well, let's take a look at how markets are tracking at the moment. We're seeing a lot of selling on the ASX. Here in Australia, stocks off more than 2% right now. This is after that hawkish cut from the Fed, 25 basis points as expected. But of course, the outlook for 2025 in terms of further easing, very much an open question. Every sector on the ASX weaker. One stock-specific story that we're watching, ANZ, one of the big four banks, that's off by 2.5%. This is after the outgoing chief executive, Shane Elliott, had his final pay packet voted down. So that's a strike against the board, 2 strikes against a board motion, and we could see a board spill. So the ANZ board obviously wanting to avoid that at the AGM. Nikkei futures, meanwhile, continue to slide deeper into the red, off by 2.5% now. It is, of course, a Bank of Japan decision day coming up tomorrow. So we're going to be watching car makers at the open as well there. A little bit of extra spice to the Honda-Nissan story as well. Foxconn interested in a stake. Honhai has, of course, been investing in EV factories. Honda was down about 3% yesterday. Nissan, though, hitting the upper limits for a while there. Let's take a look at forecasters, beg your pardon, Forex as well. Everything suffering under the strong US dollar. We've got the yen back down at 154.63 now. The offshore yuan now the lowest since 2023. The euro softer against the greenback as well. The dollar spot index up almost 1% after that Fed decision. All right, stay tuned. Market opens in Seoul and Tokyo up next. Let's see what happens. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens after the Fed cut rates for the 3rd consecutive time and actually signaled only 2 rate cuts in 2025, which Paul sent the S&P 500 to its worst reaction on a Fed day since 2001. And this is the setup for the BOJ to come out in a few hours with its decision on rates.
Absolutely. That market reaction most certainly profound. Was it rational? We'll discuss that in a moment. But you're quite right. The BOJ coming up next. One would hope that that's reassuringly dull. But with Governor Ueda and the BOJ, you never quite know. We're not expecting a cut, but some of the commentary could certainly be interesting, Shery.
Yeah, right now we are seeing the Japanese yen holding at that 154 level against the U.S. dollar. Of course, it's really been about Treasury yields and the dollar surging in the overnight session. And we have seen implied volatility for the yen overnight, also spiked by the most since the U.S. presidential elections. And could the weakness of the Japanese yen spur the BOJ to do something at this meeting? Well, as you said, the expectation is for no change this time around, although who knows what happens in January, right? The Nikkei right now falling more than 1%, and this is a 5th consecutive session of falls. I mean, we have seen it move away from that peak that we saw it in the summer. Let's see if we continue to see the pressure, but investors probably a little bit more concerned right now about the BOJ policy decision in the next few hours. Take a look at how the Kospi is trading right now. Of course, that market has been really dealing with political uncertainty. We have seen that market pressure just because of the uncertainty of what happens at the Constitutional Court with the impeachment of the president. We are seeing continued weakness on the Korean won right now at that 1,400 level, and the Kosdaq also losing 2.4%, Paul.
Seeing some very steep losses here in Australia. We've got the ASX now off by more than 2%. We've got every single sector in the red. And in fact, we have just 5 stocks in positive territory at the moment. The Aussie dollar also suffering as a result of that much stronger greenback. Take a look at New Zealand stocks as well. Not doing too badly considering, off by 1.1%. But we did have some terrible economic news out of New Zealand a little bit earlier this morning. Third quarter GDP absolutely falling off a cliff, down 1% for the third quarter, 1.5% on year. That was a lot worse than was being forecast. So New Zealand back in recession, a triple dip. And we've just had business confidence numbers out of New Zealand as well for the month of December. They were bad before, now they're even worse. A reading of 62.3, and the Kiwi dollar also slumping against the greenback, right now just hovering above 56 cents. Let's take a look at what's happening in the Treasuries market as well. That wasn't spared the reaction following Jay Powell's presser either. We've got bond yields rose the most on a Fed day since the taper tantrum way back in June 2013. That was, of course, when the Fed signaled it would be dialing back QE. So big moves there in the bond markets, and the Bloomberg MLive Pulse question today is whether or not we're going to see the 10-year yield hit 5% sometime in 2025. Anyway, let's take a listen to the man of the moment, Fed Chair Jay Powell. This is what he had to say.
The committee decided to lower the target range for the federal funds rate by a 0.25 percentage point. Committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. To cut further after this point, I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market.
Just to get back to that point on currency, let's take a look at the Korean won. It started trading, and there you have it. Now the lowest against the US dollar since 2009, breaking through that 1451 resistance levels. So 1451.63 for the Korean won versus the dollar. The dollar was up against pretty much everything. Let's bring in Kerry Craig now, global market strategist at JPMorgan Asset Management. Kerry, as we were mentioning there, pretty much everything selling off. It was just the greenback that got stronger, really. We're seeing Asian markets softer as well, the S&P having a really rough day. Was this market reaction rational in your view?
Well, I think it's, and good morning, I think it's a case of thinking about, we all knew it was going to be a relatively hawkish cut from the Fed, but the language they used in the press conference was obviously much more hawkish than had been expected, and dialing back that rate cut expectation for just 2 next year is in line with the markets, but I guess the risk now is that they've only opened the door to say they may not cut rates at all if they look at the timing and the extent of how far they are going to loosen policy. And it was pretty clear some of the committee members are thinking about the incoming government in the US and what those policy changes may be when it comes to tariffs as they form their own views for where the economy is going to head. And I think the market is just adjusting to that. For us, a lot of what happened this morning hasn't changed the backdrop of what fundamentally is still quite a resilient US economy, inflation that's normalising, and a labour market that's cooling and not collapsing, which is quite good for both stocks and bonds, and particularly for risk assets around equities and credit.
Yeah, you make an important point there. Are we losing sight of the bigger picture that good news could actually be good news? We've got US growth still robust, the consumer's in good shape. Jay Powell noted how the jobs market is holding up as well. When you look around all the red on your screen today, do you see an opportunity to buy? If so, what?
Well, I think that's the case. If everyone's been worried about rising valuations, the tightness and spreads coming through the credit market, I mean, it would be a case of buy the dips in our mind, because we do have a very much a risk-on stance when it comes to asset allocation at the moment, given we have a view that you're seeing an expansion of the global economy, which is driven by the US economy. So for us, if valuations do come off a little bit, if yields back up in the government bond space, I think that's an opportunity to add rather than say we'll see an extended flight to safety at this point.
Where would you add? I mean, you seem to be optimistic about the U.S. economy and just a broader global economy at this point. Does that mean that you would be adding some of those cyclical sectors?
Well, for us, it is a case of thinking about, you've had this really large run in those mega cap names in the US, and we still very much prefer the US equity market to others around the world at the moment. But we are expecting that broadening out to come through some of those other 493 names that we've seen. If you look at the earnings outlook, that is definitely the case. And we see that contributing more of the earnings growth in the US. So we would be looking at those opportunities to move slightly down the market cap in terms of more mid-cap stocks, and also into those other more cyclical sectors, which should benefit from a lot of the sort of policies around deregulation and just sort of more pro-growth changes that you see come into the US economy. And then the similar on the credit side, we're not thinking about a recession, so very happy to look at towards the high yield market, towards look at investment grade credit, where, granted spreads are tight, but we are still seeing quite a compelling case for thinking about all-in yields and the total return you're getting off those parts of the fixed income market.
What does it mean for Asian markets if we continue to see a strong U.S. dollar? I mean, we saw the Korean won now at levels that we haven't seen since 2009. You would think some of those exporters would benefit.
Yeah, it certainly is a struggle in terms of just looking at that historical relationship. Typically, emerging market equities, don't do well on a relative basis to the developed markets as we see the dollar rise, and so it does create a headwind. If we get a Federal Reserve that is moving into an extended pause, it does again become more challenging for emerging Asian central banks to cut rates. And we obviously had holds from Bank of Thailand and Bank of Indonesia recently. So I think that's the real challenge about the amount of easing that can come through there to support domestic growth. And we are going to have some of these challenges around what is the outlook for tariff policy, what does that do to growth, and will it have broader negative sentiments around business, corporate confidence coming through, which is the real headwind to thinking about performance of EM Asia assets. For us, the valuation case is still very much there in terms of thinking about longer term performance, but it does become a much more active case across the region when thinking about how to allocate to emerging market equities at this point.
Kerry Craig, Global Market Strategist at JPMorgan Asset Management. Always good to have you with us. We'll be also looking ahead, of course, to the Japan trade, given that we do have the Bank of Japan decision today. More ahead on the Asia trade. This is Bloomberg.
What's the rush to keep cutting rates? Let's just back up a little bit. I think also they do have to listen to what's being talked about at Mar-a-Lago.
With this hawkish tone, this is sort of the perfect way for him to say, we're doing our job, we're looking at the data, it's coming in stronger, the economy's solid, and it justifies higher rates.
This is not going to be a great forecast for where the Fed's future forecasts have been, because they've been just so whipped around by short-term movements in data.
I think today's message was they have less conviction about that downward path of inflation.
Even with a 25 basis point cut, they maintain that level of restriction, and that they're still kind of being able to balance the risks assessment.
Bloomberg TV guests reacting to the Fed's decision to cut rates. Take a look at how Japanese assets are trading at the moment. We are seeing the yen pretty range bound. Of course, we had a lot of strength for the U.S. dollar in the overnight session. The Japanese stock market under pressure right now, down 1.7%. And the Nikkei, every sector in the red right now, with tech and real estate leading those declines. This is the fifth consecutive session of losses for the Nikkei right now. We have seen a little bit of a rebound from its August low, but we continue to feel the downside pressure as we head, of course, towards a BOJ policy decision. And the expectation right now is for no change. Swaps markets pricing in a less than 20% chance of a rate hike. Let's bring in Bamba, Japan head of active investments at BlackRock, who joins me now in the Tokyo studio. Good to see you in person here in the Tokyo studio. Let's talk a little bit about what the market reaction could be if the BOJ holds as expected, or if it surprises.
Yeah, good to be here. I think that the market is going to react more to global risk sentiment and global markets rather than what the BOJ is going to do today. We think it's likely that they'll hold today, and that's very much priced in or expected in the market. We don't think that the BOJ is so much going to react to events overnight. But, whether they go today or not, if they don't go today, they're going to go in January. And, there is not that big of a difference between going in December or going in January. So I think that much is very well telegraphed. And I think, the fact that the BOJ is on a gradual path towards normalization, and their messaging continues to be that when they look at the domestic economy and the conditions in the domestic economy, all the bits and pieces of parts are in place to allow for a gradual normalization of monetary policy. So I think that's the big picture.
Gradual normalization here, but also the Fed seems to be very gradual at this point and even running the risk of potentially cutting much less than the markets are priced in. If you have that sort of pressure in the U.S. markets and the U.S. dollar, what does that mean as an implication for Japanese markets?
So I think that it enables or makes it slightly easier for the BOJ to continue on with their policy normalization of increasing interest rates. And,
even with a very weak yen?
Even with a very weak yen. And I think that our position, our view has always been that increased normalization, rates going higher in Japan is good for the markets. It's good for bank earnings. It's good for savers. It's good for, velocity of capital. It's good for animal spirits. So all those things the market should welcome, and it should be good for the equity market.
What happens if domestic demand is stalled in Japan, though? I mean, we know that a weak yen is good for exporters, but maybe the small names, the domestically focused names, because of higher imports, could that be hurtful in the broader market sense as well?
Yeah, and I think that, the BOJ continuing on with interest rate normalization is actually going to help support the yen, so that'll be a positive from that perspective as well. But, economic conditions in Japan are quite strong. They're quite robust. You look at, corporate earnings are strong, corporate sentiment is strong, wage growth is very strong. It's going to be strong again next year for the third year in a row, and these are very high levels that are being sustained for third year in a row.
I can see you're very optimistic right now because we haven't seen this in Japan for so long.
We haven't seen this in over 30 years, and so if you ask why is this time different, that's why this time is different. And so I think all those things are in play, and certainly the market is going to be affected by global risk, outcomes, and there is a lot of uncertainty out there as far as where the U.S. goes and so on and so forth. But separating away from that, what's going on domestically in Japan I think is quite encouraging.
You would just be interested also in your view on Japanese automakers at the moment, just in general terms, in the context of this potential tie-up between Honda and Nissan. What are you seeing around consolidation at the moment and the competitiveness of the Japanese auto industry?
Yeah, that news with Nissan and Honda was a big one. It was an interesting one, and I think for that particular transaction to play out, it's going to take time. It's going to take time. It's a big, complicated transaction. So we'll see, how they execute it and what actually happens. But I think the reality is that if you want to compete in the auto industry in this day and age, you need scale. And these three companies coming together certainly create that scale. They become the third largest auto company in the world, right? So I think it's a long-term positive from that perspective. It was probably something that had to be done at some point, and the fact that it's being done now, I think it's sort of interesting in that this also fits with the theme of Japan being more front-footed and embracing change and finding ways to reinvent itself and to evolve. And so I think from that perspective, this is encouraging.
We're seeing pretty much every asset you can imagine selling off today, but one thing that is strengthening is the US dollar. We're seeing some corresponding softness in the yen. What do you see going forward for the yen in the context of the BOJ decision, not just today, but in January, and the future of the carry trade?
Yeah, so I think, over the long term, we see the yen as being undervalued and, should richen over time as interest rate policy evolves in Japan and also in the U.S. But I think that, the yen has, as was mentioned earlier, largely been sort of trading sideways, over the past year or so with some volatility. And it's not really central to the real economy or to corporate earnings as long as the moves aren't vicious and extreme. And we don't really have any reason to believe that why it should be. So that's kind of our view on the yen. And as far as the markets, yeah, things are a little choppy right now. But if you look back on the year, 2024, Topix is still probably going to be up around 15% on the year, which is quite good, and quite good, especially after coming from, an even stronger 2023. And, the point here is that valuations aren't extended at all because earnings have delivered. And so, from a corporate fundamental perspective, we expect more or less the same next year of earnings continuing to deliver and that translating into strong performance from the equity market.
Are you seeing more money staying within the country? I mean, given, of course, a changing environment right now, the rate environment, also how attractive it is. We have seen, for example, large institutions buying less foreign bonds than before.
Yeah, I think what we see is money being put to work. Money that was kind of like, sitting in bank deposits before being put to work into more productive uses, including risky investments. And those investments go into, global stocks, for example, or into CapEx, or into wage growth, or even, domestic Japanese investments. And so wherever that goes, so it's not all going into Japan, it's also going into global areas. But wherever it goes, I think that the risk sentiment coming back, risk appetite coming back, animal spirits coming back, shift from a savings culture to an investing culture, that's the big shift that we've seen over the past couple of years.
The big risk that we talk about right now is an incoming Trump administration, right, which will take office 4 days after the BOJ's January decision. What are the implications for Japanese assets, especially if we see tariffs, if we see just more trade tensions around the world?
Yeah, I think there are definitely uncertainties associated with that. But as far as tariffs, I think I go back to our companies at the end of the day have products and services that are quite differentiated and, are high value add and essential to a lot of businesses worldwide. So that should give you some protection. And then the other part that I think is unique, a unique driver to Japan, is the domestic dynamic, right? We have exit from deflation, corporate reforms, animal spirits, those things that should, add energy to the financial sector, for example, or to consumer stocks, for example. And so those drivers, those unique drivers to Japan should also help our market.
You, Bamba, good to see you here in Tokyo. He's the Japan head of active investments at BlackRock as we look ahead towards the BOJ decision just in a few hours. And you can also turn to your Bloomberg for more on the Bank of Japan. And, of course, go to TLIV Go to get commentary and analysis from Bloomberg's expert editors. This is Bloomberg.
Well, let's have a look at how futures in Europe are opening. Perhaps unsurprising to see more red on your screen there. Stocks 50 futures off now by about 1.5%. Of course, we've seen heavy selling in all of the major equities markets since that hawkish cut from the Fed, and the indication that there might only be 2 more cuts in 2025, which has, of course, led to plenty of speculation that there might end up being none at all. We did have some other news out of Europe. The French Senate has adopted a stopgap budget bill, so the government there is at least going to be able to keep functioning from January until it manages to adopt a budget sometime in 2025. Bloomberg Intelligence, meanwhile, forecasting that the ECB is going to keep on lowering borrowing costs at every meeting until March. Shery.
And Paul, downside across Asia right now, we are seeing the Nikkei losing ground and every sector in the red. The Kospi is also down 1.7%. We saw the Korean won now fall to the lowest level since 2009, and really going back to those levels that we saw after the impeachment declaration, not the impeachment declaration, the martial law declaration by President Yoon Suk-yeol. The ASX 200 also losing almost 2%. But really what we've been watching is the auto sector in the last couple of days, right? One stock that's bucking the trend here here in Japan is Nissan, which continues to gain ground right now, more than 4% after gaining more than 23% in the previous session. Honda continues to lose ground. We're talking about the lowest levels now since the summer of this year. All of this, of course, on that idea that these two companies could really potentially merge to create a stronger rival to Toyota. And we've learned a few more developments over the past 24 hours. Let's bring in transport reporter Nick Takahashi, who has more on this, because now we're understanding that perhaps Foxconn was a catalyst for these conversations.
Yeah, the arrival of Foxconn in the conversation definitely complicates the situation. The company, the Taiwanese manufacturer, has always been interested in the EV industry. Back in 2016, it took a two-thirds stake in Sony, and the speculation now is that it tried to do so with Nissan this time, maybe targeting their production facilities to get into the EV market. That said, the Honda merger, Honda talking with Nissan is ongoing. We're expecting more news on that next week, but how that shakes out, what influence Foxconn's presence has on that, I think only time will tell.
What are global partners saying, the likes of Renault and so forth? Because this is a very difficult and challenging environment for global automakers, right?
Our reporting tells us that Renault wouldn't be against a Honda-Nissan merger. For the most part, I think it's fair to assume that Renault, with its stake in Nissan, would be happy that makes whatever the car maker healthier. How Foxconn factors into their calculus, I think, is a bit more complicated. Foreign ownership of the Japanese car maker wouldn't necessarily be optimal for Renault or the Japanese government.
So what does this mean for the auto industry more broadly in Japan and the global industry?
Well, effectively what we're talking about, if Honda, Nissan, and potentially Mitsubishi form an alliance, is pretty much a parting of the Japanese automotive industry. This three-way alliance would pit itself against Toyota and its partnerships with Mazda, Subaru, and Suzuki. This sort of bicameral industry would lead to a lot of domestic competition. But more than that, the conversation is about how this would help Honda, Nissan, and other Japanese car makers regain their competitive edge in North America, where hybrids are selling really well, and in China, where legacy car makers like Toyota are bleeding.
All right, transport reporter Nicholas Takahashi there, and we do see Nissan continue to extend gains today. We have more ahead on the Asia trade. This is Bloomberg.
Risk assets are selling off in Asia after hawkish signals from the Fed. We are seeing the MSCI Asia Pacific now at the lowest levels in more than a month. Our markets editor David Ingles joins us now for an early read across the Asia Pacific. David, is this a justified response given how traders have to sort of pare back those expectations of easing from the Fed? What's top of your mind right now?
I think to the extent that which we continue to see the sell-off today, and I think a very small positive note as we get underway today is, S&P futures are steadying, which might indicate we are getting dip buyers going into the Thursday session. But as expected, though, to your other point, Asia will continue to see a lot of selling pressure today. We're down at least 1% on the major benchmarks. A couple of levels to watch. We cut through the 50-day moving average on the S&P 500. The next level to watch are about 100 points below the current level on the contract itself. The next level to watch below that takes you back to the November lows. So just watch that closely. It doesn't look like we'll get there today, but certainly some next levels to watch after we cut through the 50-day moving average. Now, speaking of green circles to watch and moving averages, we've taken that out on the Asian benchmark. In fact, we've taken out the 100-day, and we're now at risk. And currently, after the open in Japan and South Korea, we're now below the 200-day moving average on that. So certainly there is a lot more selling pressure in the Asia Pacific. And a lot of that also has to do with, up until recently, it's been, again, we've been talking about this U.S. exceptionalism and the dollar strength, which, by the way, going into this Fed meeting, the next chart's going to show you this, there were signs of exhaustion coming through as far as momentum goes. But because of that sort of change and that sort of confirmation that rates next year will probably settle at a higher floor, we actually took out this trend line overnight going into where we are in the Asia Pacific. So I guess you guys were talking about the South Korean won. As far as the Chinese conversation goes, I'll end on this, Paul. The offshore renminbi is actually within 0.5% of an all-time low. So we'll see what the fix and any potential anchoring out of Chinese officials will be today, given the cross-asset move we're seeing so far. Back to you guys.
All right, China Show co-anchor David and Glaze there. Let's take a look at what's happening on the bond market, because, of course, that wasn't immune to the post-Fed fallout either. We've got the 10-year yield now at 4.508. We did see bond yields rising the most on a Fed day since the taper tantrum way back in June 2013, and that was, of course, when the Fed signaled it was going to start dialing back QE. Take a look at the yield on the Chinese 10-year as well, 1.759. This is coming after, well, just a day after the PBOC urged financial institutions involved in aggressive trading in the bond market to pay close attention to relevant risks, including rates. Well, we'll see about that. Japan 10-year yield, meanwhile, just above 1.1 ahead of today's Bank of Japan decision. All right, let's bring in Anders Persson, head of fixed income at Nuveen. Anders, I just want to start off with your reaction to what we heard today from Chair Powell, and based on the dots, looks like we might only get 2 Fed cuts in 2025, although that's opened the door to a conversation about potentially 1 or even none. What's your view?
Yeah, I would say certainly Fed delivered sort of this hawkish cut that we were expecting. I would say the market was expecting. But I think to your point around the dot plot, I think there were a couple of things that the market really reacted to, and where we've seen such quite a big move here. To your point, I think that number one, the dot plot, going from 4 cuts in 2025 now to only 2 cuts. I think that was, not too surprising, but the market definitely was perhaps, dialing in on that a little bit. I think, secondly, the fact that we had updated core inflation expectations, so that went from 2.2% to 2.5%, so pretty drastic move higher. I think that really had, market kind of reading into both this concern around stickier backdrop from an inflation perspective, but perhaps also trying to read into if the Fed is having some expectations, maybe some concerns around upcoming fiscal policies, and how can that potentially play in here going into next year. So, fair amount to digest there. I think the market tried to, play a little bit of a catch-up, maybe even trying to get ahead of the Fed a little bit here going forward. But certainly from a direction perspective, it certainly feels very rational.
Yeah, well, we saw yields rising, as I mentioned there. What are the chances, do you think, that we see a 10-year with a 5 handle in 2025?
So we've been saying for some time that 4.5% 10-year is about fair value. So we're basically right at that, and we could see a bit of a range between 4.5 and 4 3/4. We do not see the 5% kind of handle as a base case as we move into next year. Certainly can't be ruled out, and I think as anything right now, the market will be very focused on data coming up, particularly on the inflation and the job side. So, I would say that seems like a bit of a stretch as we're sitting here today, particularly as the Fed is still committed to cutting rates going forward, and the market is kind of sort of expecting that as well. So, it would really have to be some inflation surprises and perhaps something around the fiscal policy. So I think for now, as we're sitting here today, the base case would be that that's a bit of a stretch. Again, we're thinking 4.5 is more fair value, and we could see that being sort of the anchor for most of 2025.
And we've already topped that 4.5% level, right, for the 10-year yield. What does that mean in terms of having to be more selective when you're looking at credit sectors, also duration?
Yeah, we certainly have been less excited by rates and less comfortable going long duration for some time. I would say right now with this yield kind of change, overnight, so to say, it's a little bit more exciting on the rate side and duration side. But For now, we're continuing to focus more on the credit side of things, the securitized part of fixed income. We really like the income opportunity and the yield part of that, kind of fixed income market, so to say. We are actually comfortable going a bit below investment grade. So, for instance, leveraged loans is an area that we're particularly constructive on. Given this higher for longer expectation, clipping that very attractive yield around 8.5% to 9%, we think make a lot of sense. And ultimately, the U.S. economy is holding up better than expected. So, sort of a soft landing, no landing means that we're more comfortable with credit. We have been of the view that spreads have been a bit on the tight end, so seeing kind of that, moving a little bit wider today is giving us a little bit more comfort. But all in all, we like the income part. We're comfortable with credit. We're also finding opportunities on the securitized credit side. So diversifying across fixed income is very attractive right now.
Do you also like municipal bonds if you're thinking that the fundamentals remain relatively strong broadly in the U.S. economy?
Yeah, so municipal bonds has been one of our key areas of focus that we are particularly excited about. Particularly now post-election, there was a fair amount of issuance coming ahead of elections. So the technicals were a little bit imbalanced from that perspective. But to your point, the fundamentals are holding up really, really well. And again, with the economy being as strong as it is, we do feel like the taxable muni space in particular is holding up really well, and broader munis as a whole. It's also offering a nice diversification to the broader credit space. And actually, parts of the muni space has been lagging a bit here of late. So all in all, we're finding the municipal space to be an attractive entry point at this point.
And as we've seen yields on Chinese bonds cratering, do you see this trend continuing, notwithstanding warnings from the PBOC?
Yeah, it's been a tricky market on the Chinese side for sure, and we could see that trend, continuing. Quite frankly, at this point, given there are so many crosswinds, with that broader region and those markets, we have been a bit cautious and likely continue to be a bit cautious on that space. But for now, we're really comfortable with the U.S. market primarily, and I'm kind of focusing on that side. A little bit less excited given the noise level, particularly in China. South Korea is another region that we're a little bit more cautious on, just given so many moving pieces at this point. So all in all, kind of focusing in, particularly on the fixed income side, particularly on the credit side from a U.S. perspective.
And Anders, before we let you go, of course, we're headed towards a BOJ policy decision as well. We're seeing the 10-year yield here on the JGB at the highest level since 2011 or so. We have seen a bit more money staying in Japan, less foreign bond purchases, more of the nation's domestic bond purchases. Is this a trend that you see continuing given the divergent rate policies right now? And what does that mean for the giant carry trade that we've seen in the past few years?
Yeah, I mean, it certainly is a divergence going on, particularly with most of the rest of the world at this point, including the U.S., including Europe. So at some point, we do think there's going to be some opportunities here. We do think there's a recession hedge even in some of the global rates strategies that we run by playing kind of this part of the market, so to say. We've been a bit cautious on the Japanese kind of rate side, given some, again, moving pieces that we're dealing with, and the fact that the Bank of Japan likely will continue to move their rates higher. So we've been adding some long end JGBs on yield backups and trying to be opportunistic, but still, quite a lot of moving pieces here, and we want to see how this plays out over the coming months as, kind of basically Ueda is trying to react to what's happening, not just with the economic side, but some of the political backdrop that he's facing as well.
Anders Persson, good to have you with us. Head of fixed income at Nuveen as we head towards the BOJ policy decision in just a couple of hours. And if you missed any part of this conversation, TV Go is your function. You can also watch us live. You can also dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation by sending us instant messages. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg. Dollar strength is really pressuring all currencies on that other side of that trade. The Brazilian real falling to a 4-month low, leading those declines in EMFX, while we have the Mexican peso also topping that 20 level, and the offshore yuan right now sitting at the lowest level since last year. And this all, of course, with the possibility that the Fed might pare back those easing expectations for next year. Already the expectation is for 2 rate cuts only. The expectation before going into this rate decision was for 3, but could we see even fewer rate cuts, of course, is a key question, Paul, as we continue to watch also Chinese economic growth. And now Nomura saying that they will probably disappoint next year to around that 4% growth level.
Well, we've got Chinese President Xi Jinping in Macau for a 3-day visit to celebrate the 25th anniversary of the city's return to China. For more, let's bring in our China correspondent, Min Lo. So, Min, tell us about this trip so far and the significance of it.
Yeah, President Xi arrived yesterday afternoon with his wife to great fanfare. There was a big cheering crowd. There was a lion and dragon dance. And one of his first public remarks after arriving is to laud what he calls the universally recognized success of the one country, two systems model with Macau characteristics. We know this is his 3rd trip to Macau as president. The last time he was there was in 2019. At that time, the neighboring city of Hong Kong was going through some political instability with the anti-Beijing protests happening at the time. And we know Beijing has very often praised Macau for being this model of harmony, stability, and loyalty. He is there this time to meet with the outgoing chief executive, where he thanked the chief executive for his work in maintaining national sovereignty and for leading the city out of the COVID-19 pandemic. We know President Xi will attend a gala dinner tonight, and he will be attending the inauguration ceremony of the new chief executive tomorrow.
Yeah, what can we expect from him?
Yeah, the new chief executive, Sam Ho-Fai, he is a man of many firsts. He is the first chief executive of Macau to not be born in the city. Instead, he's born in the southern Guangdong province of China. He's also the first to not hail from the business background, and instead he is a former judge, someone who is clearly endorsed by Beijing, given that it was an uncontested election. He was overwhelmingly supported by the 400-strong election committee made up mainly of Beijing loyalists. And some analysts have said that his appointment would mean that Beijing's policy agenda will take greater priority, perhaps meaning a decline in the influence of the business circles, which critics have in the past accused of colluding with officials. And he takes over the city's agenda, which is also Beijing's agenda in some ways, to diversify Macau's economy away from just gambling and casinos, which now contribute to about 80% of the city's tax revenue. And the city aims to be this global hub for tourism, commerce, finance, and also expand into traditional Chinese medicine, for example. And he has vowed to do more to address the issues concerning people's livelihoods.
Bloomberg China correspondent Min Lo there. And the latest from the corporate front as well. The U.S. Supreme Court says it will hear TikTok's challenge to a law that would ban the app next month if it isn't sold by its Chinese parent company ByteDance. The court scheduled arguments for January 10th, allotting 2 hours, which is double the usual time. Unless the Supreme Court blocks it, the law will take effect January 19th, the day before President-elect Donald Trump is inaugurated. Bloomberg's been told that distressed Hong Kong property firm New World is in talks with banks to extend the due dates of some bilateral loans. Sources say it's unclear how much of a delay the builder is seeking for each loan. New World had total liabilities of $28.3 billion at the end of June after its first annual loss in 2 decades. Apple is said to be scrapping a project to build an iPhone hardware subscription service. The idea would have involved consumers paying monthly fees and getting new phones annually. Apple earlier binned its Buy Now, Pay Later program, which allowed shoppers to pay off purchases over multiple installments. Barclays is set to increase annual bonuses by up to 20% in its investment bank. Sources say staff in the trading unit are expected to see a 5 to 10% rise in their annual awards. Bankers in debt and equity capital markets could see bonuses jump by between 10 to 20%. This is a turnaround from last year when dozens of bankers got no bonuses. We have more ahead on the Asia trade. This is Bloomberg.
Let's take a look at how we're doing here in Australia. Short answer is not terribly well. We're off by more than 1% at the moment. Every sector on the ASX weaker as well. We've got a weaker Aussie dollar also, but to be fair, pretty much every currency is weaker against the greenback, which rose almost 1% on the dollar spot index following those remarks from Chair Jay Powell. ANZ Bank there at the bottom of your screen, that's off by 2.25%. Interesting time at the company's AGM, stockholders voting down the outgoing CEO Shane Elliott's remuneration package. So the board hastily making some rearrangements to avoid a second strike. So we've got ANZ shares off by 2.25% at the moment. Well, all of that notwithstanding, it was a pretty good year for Australia. The record-breaking stock market rally expected to continue into 2025 as the likelihood of easy central bank policy boosts sentiment and China's stimulus pledges support for miners. So for more, let's bring in Asia equities reporter Georgina Macau. So, Georgie, we've got the ANZ off today, but if you look back over a year, we're up about 7.5%. So how much further can stocks rally?
Yes, don't let today's at 1.2% drop discourage you, Paul. It's been a pretty decent year. Prior to today, we're up 10%, and that's the best year since 2021. And the market watchers, analysts, investors are seeing that rally continue into the new year. So likely going to be another green one. We've got a rate cut coming in the first half. We've got Australia perceived as a relative safe haven within the region. So if we're seeing geopolitical volatility globally, then money could get parked in Australia as somewhere to withstand those movements, I suppose.
In terms of sector moves, what were some of the notable moves that we saw, and is that going to be repeated next year?
So on the positive side, banks was one that is definitely worth mentioning. So the banks rally was just blowing the mind of the street. So CBA, for example, is the most expensive mega bank stock in the world, more expensive than the likes of JPMorgan, and it has mostly sell ratings and then a couple of holds and no buys. But within the banking sector, that rally just kept going, and for a few reasons. So we had elevated interest rates throughout the year, and then we had a situation where people were trying to not have exposure to China. So Australian banks are a good way of doing that, rather than Australian miners, which are quite exposed to the highs and lows of China demand for, say, commodities. So, and then we had in the single stock space, Zip and Qantas, two standouts. So Zip digital payments company, best performing digital payments company in the world for the year on US growth prospects, and then Qantas had a decent year with cheaper fuel prices fueling its rally. And then on the negative side, the laggards, we had energy stocks and mining stocks not having a great year. Mining stocks had the worst year, on track for the worst year since 2015. And a lot of that's being driven by China's uneven economic recovery. And then looking ahead, if we see China's stimulus come through and we're seeing a bit of a rotation from banks to miners, then that could serve that sector quite well.
All right, Asia Equities reporter Georgina Macau there. Let's take a quick look at how some of the benchmarks we're tracking are performing today. Look, not well, really, which reflects what we saw out of the US. The S&P having one of its worst days, the worst post-Fed day, in fact, since 2001. We've got the Nikkei, though, off by about 1% at the moment. Stocks in South Korea weaker by 1.6% as well. Take a look at New Zealand's performing reasonably well by comparison. But it was we had some horror data out of New Zealand a little bit earlier. Third quarter GDP absolutely falling into a crater, down 1% in the third quarter. We were expecting a 0.2% contraction. So New Zealand back into recession, a triple dip there. Let's take a look at some commodities as well. Oil trimmed its gains post-Fed. partly a function of the surging US dollar. We have seen strong US crude exports, ongoing concerns, however, about very weak China demand. Gold continuing to hold up well as a haven play, better by 0.4%. Iron ore, meanwhile, slipping by about 0.2%. Shery.
And you mentioned really the surge in the U.S. dollar, which is pressuring all currencies on that other side of that trade. And you're seeing the Japanese yen holding very close to that 155 level as we head towards the BOJ policy decision. And the expectation right now is for no move. But we have seen implied volatility rise overnight to the highest really level since the U.S. election. The offshore yuan had already fallen to the lowest level since last year, and we continue to see it past that 730 level, while the euro is also under pressure against the U.S. dollar. Mizuho seeing the euro breaking below that 104 by Christmas. That's it from the Asia trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. The China show is next. This is Bloomberg.